Welcome back to the channel. I just wanted to talk a little bit around options, particularly regarding calls, puts, and also exploring the wheel strategy, which is a common strategy that's employed by retail investors when they actually invest and buy options and trade options. So an option gives you the right, but not the obligation to buy or sell an asset at a set price, often referred to as the strike price. Each standard contract represents 100 shares of the underlying stock. That could be Tesla, Nvidia as examples. The price paid for the right is called the premium, which is kept by the seller regardless of the outcome that's taking place. All right, so let's look at the two sides of an option. So the most common one is the call option, which is the right to buy. So you buy a call when you are bullish and you believe a stock's price will rise. It lets you buy shares at a locked-in lower price. So from a buyer's perspective, it's unlimited potential profit with the risk limited to the premium that they've paid. So, ultimately they are going to be very bullish on the stock. They want to get it at a lower price and then hope that when they acquire it, that it will, ultimately run through. The seller's goal is to earn the premium income, believing the stock will rise, but it won't rise above the strike price that the current market sets it at. So obviously there's always this balancing act between what you're trying to achieve. Looking at put options now is the right to sell. So you buy a put when you're bearish on a particular underlying and you're kind of expecting the price to fall. It can be also used as an insurance for stocks that you own. If you feel like you're owning a stock and it's going to drop, you can do a protection that says if it drops below this certain value, then sell it and you'll collect a premium. Buyer's goal in this instance is to profit from a price drop with the limitation on the premium being paid. So that's the risk. The seller's goal is to obviously earn premium income or acquire a stock at a low effective price if assigned. This is a great mechanism for value investors. If you generally believe a stock is overvalued, you let it drop, you set a price that you're willing to pay for it, that you think it's valued at, and then you can collect the shares at that price. So I think for value investors, this is a really good strategy. I know there's a lot of misconceptions around puts. And so I think it's quite important that people understand that puts aren't a bad thing. I think just because they're a bearish strategy, people just don't like them. But they do have a value in a portfolio. And there is a reason why people do puts. Let's look at a profit and loss scenario now, assuming a hypothetical stock, doesn't matter, XYZ, with a $50 strike price and a $5 premium per share. The tables below kind of give you a view from the different lenses. So if we look at it from a call option perspective, if we look at the kind of things now, the $55 is kind of the break even for the buyer and the seller. But what we can see is if it goes below, the buyer is going to lose out, but the seller will benefit. If we go below, the buyer is capped basically. And so what you have to look at is 60, 65, 70, they will make the extra profit and the seller will make the loss in this instance. So again, what you've got to realize is that the profit and loss side of things are very important. There is no free lunch out there. The market is quite efficient when it comes to options. And the inverse is also true for puts. So, as the price goes down, value goes up, the buyer, and for the seller, if the price goes up, then they're in the profit. So there is someone that's always going to lose out on the other end of the trade. Unless we hit that break-even price, then nobody loses. So yeah, again, just worth kind of mentioning and understanding the break-even prices and then the different views between a call and a put. Okay, in terms of just understanding the premium element of options, we have the concept of what we call time value and the intrinsic value. And I kind of want to break this out. So for an in-the-money option, the premium is mixed up of the intrinsic value and the time value, whereas the out of the money options are 100% time value. When we look at the balance here, typically the intrinsic value is normally about 60%. The time value is normally around 40%. When we talk about time value, we are basically looking at something called theta, which is typically in the options world known as the Greeks. And one of the Greeks is the theta, which is the time value erosion. So what we'll find is if we had a expiration at 90 days, let's say, that would be the start of the time value at 100. And then you get this exponential erosion to expiry and the value of that particular option. Obviously, as we get nearer to the expiration, the value of the stock is more predictable because there's less time for it to move. The further we are away, there are a lot more events that can happen, and that's why we get that extra variance. And this is also why we find in, when it's a period of, let's say, volatility, the time can also matter quite a lot. Okay, let's touch on the wheel next and why a lot of people like the wheel. What is the wheel? The wheel is basically starting off by selling a cash secured put on a stock that you want to own, and then you sell a put below the current price and collect the premium. It's called a cash secured put because you ultimately have the cash in your account to actually cover the position that you're actually looking to buy. Okay, so the cash secured part is the ability to have that cash there. We'll talk about how you can do some of this trading without necessarily the cash or the shares, but that's probably a topic for another day. Now, once I've raised that position, there are two outcomes that typically occur. I can either get signed or it can expire worthless. If the stock price stays above your strike, the put expires worthless. You keep the premium, but then you're back to step one again to start the process again. If the price drops below your strike price, you end up buying it, the 100 shares or however many contracts you've raised at your strike price. The next step from there is you can now sell a covered call because you now have 100 shares of that stock. So the call option you can then set at a higher strike price now and collect more premium. And again, this now has two outcomes. You either get called away or it expires worthless. If it expires worthless, again, you keep the shares and go back to step 3 and another covered call. If the shares get called away, you take the profit and you go back to running cash secured puts. Now, the good thing about covered call is you can't lose money in this scenario because you've bought the shares, let's say, at $100. You set a strike of $110. You're always going to make those $10 plus whatever premium was generated. Let's say it was $2, you'd get $102, irrespective of whatever happens. The only downside is when you come back to buy, you might be buying back at a higher price. You may go and pick another stock that you think is slightly better value. Or you can write your put price at a value that you paid in the past for and keep doing that until you get the premium that you want or you get signed. So you can see this concept of this wheel going round, between the cash secure put and the covered call. Again, it's called a covered call because you actually own the shares to cover the position. There is things like poor man covered calls and naked calls, etc. Again, probably another video for another day in terms of assignment, etc. But I just want to kind of cover the concept of a wheel strategy. So the key considerations here is stock selection is crucial. Typically, people will run the wheel strategy on stocks they're genuinely willing to own because you could be stuck with them for a long time, potentially. Obviously, market conditions when it comes to these strategies, particularly covered calls, is best in a sideways or slightly bullish market. Obviously, a sharp downturn or a sharp on the upside can impact your potential. We've always got to remember with every covered call strategy, you are capped on the upside. as per before I mentioned, you're limited to that strike price, and therefore if the stock soars, you're not going to benefit from all that extra gains. Obviously, to be able to buy into a position, you need the capital. It's quite capital intensive potentially. Now, there are stocks that maybe you don't want to own, beg your pardon, long term, but you are happy to run the wheel on. Now, some people do that to start off with to generate the initial capital to get going, because there will be times when you can't afford 100 shares of the stock that you would like to earn long term, but you could run this strategy on cheaper stocks, and a lot of people do that on YouTube. So again, just to kind of mention the fact that obviously the idea of the wheel is to start off with the cash, set a price that you would like to buy at. As soon as you get signed, you can then write a call, and then the cycle continues. The good thing about the premiums are, and a lot of people don't realize this, the premiums are paid out to you as soon as you raise the contract. So that comes irrespective to you straight away. There isn't this waiting for the expiry to see what happens. You do get that cash back. You do get that cash instantly, or that premium instantly. Okay, so there you go, guys. We kind of went through end to end a very high level view of cover calls, cash secure puts, the wheel strategy, understanding the balance between the premiums from a buyer seller's perspective, and we talked a little bit around intrinsic value and time decay. So hopefully that gives you a really nice basic overview of options. Okay, guys, I'll catch you on the next one.